Today, I want to talk about one of the most interesting income investments in my portfolio right now, Blackstone Secured Lending Fund. This is my only exposure to private credit, and it's currently sitting at below 5% of my portfolio allocation. My average cost is $25.92, and recently I opened another cash-secured put at $22.50, expiring in April. The goal here is simple. I am trying to accumulate shares at prices below what I believe is fair value, while building a long-term passive income stream with double-digit yield. But before we talk about strategy, we need to understand what BXSL actually is. BXSL is a business development company, or BDC. BDCs essentially provide private loans to middle-market companies, businesses that are too large for bank lending but too small to issue public bonds. Most of these loans are senior secured loans, meaning they are at the top of the capital structure and backed by collateral. In the case of BXSL, the portfolio is extremely conservative for a BDC. As of the latest earnings report, 97 to 98% of the portfolio consists of first-lien senior secured loans. The portfolio is diversified across over 300 companies. The weighted average loan-to-value ratio is around 47%. That means borrowers typically have nearly half of the enterprise value as equity cushion before lenders take losses. This conservative underwriting is one of the main reasons I'm comfortable holding this as my first private credit position. Looking at the most recent financial results, BXSL has been delivering very consistent investment income. For Q4 2025, the company reported net investment income of 80 cents per share, a quarterly dividend of 77 cents per share. So, the dividend was covered by net investment income at roughly 104%. This distinction matters. For BDCs, the most important metric is net investment income, or NII. Unlike GAAP earnings, NII reflects the actual cash income generated from lending activities. Over the course of 2025, BXSL consistently produced NII in the range of 77 to 83 cents per share per quarter, which means the dividend coverage has remained comfortably above 100% for most of the year. This is exactly what you want to see in an income investment. Another reason I like this company is the credit quality of the portfolio. According to the latest disclosures, non-accrual loans are around 0.5% of the portfolio. The weighted average yield on debt investments is around 10%. Portfolio companies have average interest coverage of about 2 times. That means borrowers are generating roughly twice the cash flow needed to service their debt. In addition, the underlying companies in the portfolio have been growing. Borrower EBITDA has grown around 8% year over year. This indicates the portfolio companies themselves are not distressed, which is a key risk in private credit. BXSL today manages a very large credit book. Total investments are approximately $14.2 billion at fair value, while total net assets are about $6.2 billion. The balance sheet leverage sits around 1.2 times debt to equity, which is typical for BDCs and well within regulatory limits. Liquidity is also strong, with over $2.5 billion of available liquidity for new deals or refinancing. These numbers matter because in private credit, scale is a competitive advantage, and BXSL benefits from the sourcing network of Blackstone Inc., the world's largest alternative asset manager. That gives the fund access to higher quality deals than many smaller BDCs. Now, let's talk about valuation. The net asset value per share is about $26.92 based on the latest quarterly report. My average cost is $25.92, so I am effectively buying the portfolio at a slight discount to NAV. For a credit fund backed by Blackstone, that's actually attractive. Historically, higher quality BDCs often trade at or above NAV. When a BDC trades below NAV, investors are essentially buying the loan portfolio at a discount to its fair value marks. At current prices around the mid-20 range, the dividend yield is approximately 12 to 12.5% because of a quarterly dividend of 77 cents per share or $3.08 annually. From an income perspective, this is extremely attractive. However, there is an important caveat. For overseas investors, including investors in Singapore, U.S. dividends are subject to 30% withholding tax, so the net yield is closer to around 8 to 9% after tax. Still very competitive compared to most income investments globally. Now, let's attempt a simple valuation framework. For BDCs, a traditional discounted cash flow model isn't ideal because earnings fluctuate with credit marks. Instead, analysts usually evaluate these companies using dividend yield relative to peers, price to NAV, return on equity generated by the portfolio. BXSL generates roughly 11 to 12% annualized NII return on equity. If the market demands a 10% yield for high-quality BDCs, then fair value would be approximately annual dividend, $3.08, divide by 10% yield, fair value estimate, about $30 to $31. That aligns with a price slightly above NAV, which is where premium BDCs often trade. This suggests current prices in the mid-20 range are reasonably attractive. My strategy here is not short-term trading. The objective is to gradually accumulate shares when they trade below intrinsic value. Right now, my average cost is $25.92. Position size is below 5% of my portfolio. I recently opened another cash-secured put at $22.50 expiring in April. If assigned, I will be buying more shares at a significant discount to NAV. If not assigned, I simply collect the option premium. This approach allows me to accumulate the position at lower effective prices while generating additional yield. Of course, private credit is not risk-free. There are several key risks investors should monitor. First, credit deterioration. If economic conditions weaken, some portfolio companies may struggle to repay their loans. Second, interest rate changes. Most loans are floating rate. If the Federal Reserve cuts rates aggressively, BXSL's interest income could decline. Third, NAV declines. Mark-to-market adjustments on loans can reduce reported asset values. But so far, BXSL has maintained very low non-accrual rates and stable dividend coverage, which is encouraging. For me, BXSL represents a unique opportunity to access private credit through public markets. It offers double-digit dividend yield, conservative first lien loan exposure, strong backing from Blackstone, and trading near or slightly below net asset value. Because of the risks inherent in private lending, I'm keeping the allocation modest. But over time, this position could become a core income generator in the portfolio, especially if I can continue accumulating shares at discounts to fair value. That's my current update on BXSL. As always, this is simply a record of my own investment journey and portfolio decisions, not financial advice. And if you enjoy these investment diary updates, consider subscribing because I'll continue sharing real positions, real numbers, and the reasoning behind my long-term investment strategy.